Good afternoon, and thank you for joining this Yellowstone Advisory webinar. Today's company presenting is International Airlines Group, and we're delighted to have with us Stuart Morgan, the Head of Investor Relations. I'm now going to hand over to Stuart to start today's presentation.
So today I'm just going to go through a few slides, some of which we presented at our full year results back in February. I'll briefly cover off the Q1 update and latest situation from the Middle East at the end, and then, as Alex says, we'll go through to some Q&A. Just sort of starting from the top, so to speak, IAG is a portfolio company that invests in the aviation sector. And we think this is one of the strengths. The structure of the group is one of its strengths and one of the reasons why we deliver such good results. We've got a portfolio of airlines that cover a range of geographies, brands, and customer types, full service premium brands like BA and Iberia, through to low-cost carriers such as Vueling and in the long-haul segment level. We also have some non-airline operating companies, Loyalty being the biggest one, and I'll come on to that later. And then the value of IAG is in the setting the strategy and directing the portfolio, sharing best practices, and performance managing. And we think the latter in particular is a key to our success, and also to some extent talent management. So all of the group committee have worked across the business in previous roles. We've got a well-established strategy that's delivering some very good results, and that falls into three main pillars. We want to focus on our strong core, so growing the portfolio of leadership positions, those very strong positions in our main markets. We've got a world-class or a portfolio of world-class brands, so we will continue to invest in those. The second pillar is capital light earnings growth. So at the moment, this is our loyalty business, which encompasses both loyalty and holidays, and that's a very attractive business. We have some other capital light opportunities, so you'll have seen on the previous slide things like cargo, and we'll look to develop MRO over the next few years. That's maintenance and engineering. And then leveraging strategic airline partnerships. So again, this is a way to access growth, to carry people without needing to invest necessarily in aircraft. And then finally, the third pillar is our sort of value creation framework for the long term. So that's about capital allocation, it's about balance sheet management, and also managing sustainability as a theme throughout the group. So in 2025, that delivered some exceptional results. We grew revenue by 3.5% to 33 billion euros. We saw some very good growth in operating profit to just over 5 billion euros, and that was at a 15.1% margin. And pleasingly within that, you had Iberia at just over 16% and British Airways at just over 15%. And loyalty is depending on how you measure it, sort of an 18% margin business and above. We grew our earnings per share very strongly, and this was a combination of earnings growth and the halo effect of the share buyback. Net leverage continues to come down, so at 0.8 times on net leverage. And we also continue now to focus on gross leverage, which we finished last year at 1.9 times, and that also is a target for us to continue to strengthen the balance sheet. Free cash flow, just over 3 billion, exceptionally strong, a little bit lower than the previous year, given a 1 billion step up in CapEx, and then return on invested capital, exceptionally high at 18.5%, which will come down a little bit in future as we invest in new fleet, but we continue to target in a 13 to 16% range. Just sort of stepping back a little bit, demand for travel continues to be strong. We say here just in our core markets, but it just continues to be strong on a long-term basis. Travel is a protected priority. 4 out of 5 people protect their holiday spend. That demand for travel doesn't go away. People have very short memories when it comes to reasons not to travel. So it's very, very sticky, resilient demand. Specifically for us, we're seeing very good premium demand and very good North Atlantic demand, and those clearly drive significant value for IAG. In our 3 core markets, we're also seeing good revenue growth. The North Atlantic's more of a mature market for us, so probably growing kind of low to mid single digits on an annual basis in the long term. London Heathrow is the biggest premium market in the world. London to New York is the same as Paris and New York combined. So it's a very, very strong market for us, and we have good market share. Latin America is becoming an increasingly important part of our business. Whilst North Atlantic is about 30% of our capacity, Latin America is now 20% of our capacity, and the value of that market is going up. We're seeing more demand from more premium customers, and again, I'll come to that later. So for us, is at least a mid-single-digit growing market. And then intra-Europe is about 30% of our demand. It's a much more competitive market, the short-haul European market. I think this year in particular, the dynamics are for, as I say, very, very high levels of competition. We have a little bit of a niche insofar as we've got a very strong position in Spain. And then we benefit from the UK to Spain flows, which, whilst being heavily competed, are highly attractive, and that's flattish. And then if you just sort of briefly look at the rest of our business, just under 5% is Asia Pacific, and 15% is the Middle East and Africa, or has historically been the Middle East and Africa. But again, I'll come back to it later. The Middle Eastern stuff is a little bit lower for the short term. In terms of investing in our brands, we continue to invest across the business. The biggest thing we've announced recently is Starlink, which we'll be rolling out across the fleet over the next 18 months. It's exciting. I think potentially it just becomes a hygiene factor in the future, but it's something that we are pleased to be able to invest in. We're slowly starting to upgrade our lounges around the world. BA has just launched new lounges in Miami and Dubai, which are part of a new sort of signature style, and they will continue to invest in their lounges around the group. Brand partnerships. So Aer Lingus, given its 60% US point of sale, focuses on its brand specifically in the US every year and sponsors some American football games in Dublin. Digital, Vueling and Iberia continue to develop their apps in particular. BA is halfway through a commercial development program, and both the website and more recently the app are now starting to be rolled out. And then in-flight experience, this is mostly the product and as well as food and drink. And again, we continue to invest in that. And again, BA by the end of or by early 2027, everything except for its A380s at Heathrow will have the new club suite embedded. So this all helps to drive NPS, which has seen good performance improvement over the last few years. We call our sort of continuous improvement program transformation, and we divide it into 3 main areas: punctuality, customer, and cost. Punctuality has seen a massive step up, particularly from British Airways in the last few years. This is mainly a result of investment in people. So in 2023, we hired 10,000 people. It takes some time for the benefits of that investment to feed through. We're also putting in place software and AI tools that help us manage the complexity of the schedule better. Iberia has focused on its premiumization of its customer base. Historically, the South American market has been a low value market with a lower wallet customer traveling to Spain. That is changing. So we're seeing an increase in the number of high value customers. We're seeing a big benefit to the business in terms of the revenues from those high value customers. and we think that will continue to improve. And then Vueling, over the last 6 years, has been Europe's best performing low cost carrier. So ahead of any of the other low cost carriers in Europe, and in particular, the supplier cost has gone down by almost 1% in that period. And this is indicative of the quality of that business we have in Barcelona. Our loyalty business. So again, it's growing strongly. It's doubled its profits compared to pre-COVID. Year on year, 10% more active customers, 13% more Avios issued, 9% more Avios redeemed. And having put the British Airways holidays business into loyalty a couple of years ago, we're seeing good growth from that type of customer. If I sort of step back a little bit on IAG loyalty, we had a capital markets day a couple of weeks ago, and the key points that we were making as part of this was the vital part that loyalty plays as part of the IAG mix. It's a high margin, high growth, very low capital business that is becoming a bigger part of the group as it grows, and therefore kind of the mix it brings to the group will continue to improve. It's driving growth in the airlines, so the number of active customers continues to grow from about 8.5 million to just over 10 million these days, and that is a driver of value to the airlines. The hard cash that loyalty drives is at the moment predominantly through its financial services partners. So this is American Express with a co-brand in the UK in particular. So the growth that's driven that has been the penetration rate and adoption rate of American Express. So these days you can use it on the tube, you can use it in the supermarket, you can use it in everyday life, which you never historically have been able to. And then the value to IAG loyalty is the growth in the multi-collectors. So people who are not just flying and having a card, but then they might have more than one card. They might have an Uber account. They might be spending it on cruises, and the value increases significantly each time you add a way of collecting with the business. So we set a target of €1 billion of profit for that business in the medium term, and that is from a base of about 568 million euros, and you can see on this slide 507 million pounds in 2025. The other part, the final part of that bit is holidays. We are improving holidays as a business, so we're re-platforming it, and we think we can drive good growth in using that as a platform to drive adoption and growth. 80% of the holidays business revenues came from club members, but only 5% of club members book a holiday. So the opportunity there we think is quite interesting. And then as part of the loyalty business, the biggest thing you tend to spend your money on every year is your holiday. So if you can earn Avios or spend Avios through the holidays business, we think that's a big driver of growth in the loyalty platform itself. So we think that's quite an exciting opportunity going forwards. Partnerships, as I mentioned earlier, our partnerships are important to our overall positioning across the world. In the US, we have American Airlines, which is a very strong partner in that part of the world. South America, we have a partnership with LATAM in Peru and Ecuador. So we will continue to build that out as South America becomes a stronger part of the business. Qatar is very important to us. So BA historically, not at the moment, have flown twice a day into Doha and Iberia once a day. At the other end of the route, I think London has 8 Qatar flights a day, and Spain and Madrid has 6 Qatar flights a day. So you've got very strong connectivity there. Flying east from Doha, we would partner with them. Flying west from Europe, their passengers would partner with us. So all in all, it's an opportunity, as I say, to grow the business, to grow One World, to potentially grow the Avios business. Just briefly on sustainability, it's quite a challenging environment in terms of the longer term trying to understand what the longer term framework is for sustainable aviation fuel, which we think is the future for aviation. Having said that, we continue to adopt SAF. So at the moment, there's a mandate for 2% of our fuel usage being required to be SAF, and we were over 3% last year. So we are adopting it where the economics are right and where availability is right. But we would encourage, or we are engaging with various sort of governments and regulators to support growth of SAF production in particular. Our capital allocation process is also fundamental to what we do. We want to firstly prioritize a strong balance sheet, which is now in really good shape. So at Q1, we're at 0.5 times net leverage. And our objective here is always to be below 1.8 times, which is clearly a huge amount of headroom from where we are today. That's a proxy from investment grade, and that is designed to make sure that in all situations we are safe, so to speak. We're also focusing on gross leverage, trying to bring that down over time. And we also have significant amounts of liquidity, including a $3 billion RCF, which we took out in 2025. Second priority is to invest in the business. And as I mentioned earlier, we've got a target of 13% to 16%. And as I also mentioned, we're above the top of that range last year, but as we invest in the business, it'll start to come down a little bit. Combination of investing in the business and bringing down gross leverage. 2/3 of our deliveries last year were unencumbered. The majority of this year's deliveries will be unencumbered, and that will help provide some quasi liquidity as well as strengthen the balance sheet. Those are mostly short-haul aircraft, which are easily fungible if circumstances dictate. And as I said, we are investing to the extent we can in the context of delays from the OEMs and problems with engine availability and servicing times. For our shareholders, we're committed to sustainable dividends. We want to make sure that we can continue to pay dividends through the cycle. Last year, that was just under 450 million, and we'll continue to pay that through the cycle, as I said, and will broadly increase in line with inflation. And when it comes to dividend per share, obviously, again, the benefit of the buyback is that goes significantly improves the dividend per share increase year on year. And then finally, excess cash in the absence of any inorganic opportunities, which we don't see at the moment. We will give cash back to shareholders when net leverage is below 1 times. So following a 1 billion euro buyback in 2025, we've announced a 1.5 billion buyback during 2026, or at least up until our results in February next year. And we're just about halfway through that at the moment. And we plan to continue to return excess cash over the next few years, at which point we then start investing in the aircraft, which will help to drive future earnings growth. At this point, I'll just sort of quickly touch on what's going on in the Middle East. So about 3% of our capacity was flying to various Middle Eastern carriers, which includes Jordan, Israel, and Cyprus for a little bit. We've stopped most of that flying, or we've stopped the flying to the Gulf region in particular. The various airlines will plan their own returns, but we don't see any imminent return to some of those Gulf states in the near term. Some of that capacity has been redeployed, so we're flying a little bit more to places like Singapore, Bangkok, Nairobi. Longer term, we'll be reallocating a little bit of capacity to winter sun destinations, which might be seen as a substitute, such as the Caribbean. We're also doing a little bit of flying to the Middle East, to places like India, where people who may have transited through the Middle East, we can now carry them direct. So particularly US customers to India, we're now seeing some good demand from people who are now transiting through London rather than the likes of Abu Dhabi and Dubai. So that's been sort of good for the business in the short term. Iberia and Vueling both have taken their Tel Aviv flying and they're putting that into the Spanish islands, which is good business for them. So that's probably about 1% of the capacity, and the other 2% is being used as aircraft backup for fleet resilience through the summer. As I say, the problems with the time it takes to fix engines because of the supply chain at the moment is extending, and therefore we are taking some of that flying out. We're having a look at what we do towards the end of the year. So we've given guidance for the second quarter to grow at about 1% in terms of capacity, for the third quarter to grow at about 2%. And we're currently looking at our schedules for the end of the year to sort of see what the status of the fuel price, demand, and competition is, and we'll announce that probably at our half-year results. So we've reallocated the capacity. In terms of demand, we still see demand pretty strong across most of the network. The main impact, as we all know, has been on the price of fuel from the Middle Eastern conflict. So jet fuel peaked at about $1,600 a ton in early April. That was up from about $750 a ton back in January. So there's been a huge increase. We're passing that through where it's possible. So the North Atlantic, the US carriers don't hedge, so they're passing spot prices through to customers. And British Airways is remaining competitive and therefore increasing pricing in that market. Iberia is seeing some good pricing, but are growing strongly in the North Atlantic. And then Aer Lingus is also seeing high capacity growth, and it is a slightly different type of customer, as a sort of a more of a value carrier. Aer Lingus is probably the one part of the business that's struggling a little bit at the moment. But overall, the North Atlantic is a good market. The South Atlantic, the carriers there are a little bit hedged, so therefore they need to pass some pricing through, but not as much as the North Atlantic carriers. It's a relatively stable market, so you're seeing some reasonable price recovery there. And then, as I mentioned earlier, you've got a very competitive short-haul market in Europe. So pricing is at best flat in that market, if not down a little bit in the second quarter, particularly as Easter has shifted to some extent out of the quarter. So if I put all of that together, there's been some strong demand still, clearly not to the Middle East. Revenues are holding up pretty well, but the cost of fuel increased for a while and it's now coming down a bit. So you'd expect to see pricing come down a little bit as competition returns to the markets. But our focus is very much to make sure that we stay within the bottom end of our margin range. So we've targeted 12 to 15% through the cycle, and we think it'd be a very powerful message to investors if we delivered a 12% margin at least in 2026. So just bringing me on nicely to the last slide there, in terms of focusing on delivering best-in-class total shareholder returns. We continue to deliver sustainable growth. Long-term demand for travel is secular. We've got a fantastic, a unique network of markets, brands, and hubs, and our loyalty business brings strong additional growth on top of that. Our profitability remains incredibly good, and that's all about executing that transformation program. It's about the focus on revenue improvement, cost control, and operational efficiency. And that in turn, those high margins generate good free cash flow and good return on capital. And then for our shareholders, we're delivering an attractive dividend, and at the moment, shareholder returns. And on that note, Alex, I will open up to questions.
Great, thank you, Stuart. Yes, we are now going to go on to questions. And just as a reminder, if you do have a question, please type it into the Q&A box at the bottom of your screen. I have to say, Stuart, I'm pleased you are introducing Starlink, as that will improve the Wi-Fi on your BA services and make it more widely available. So pleased to hear about that. So let's kick off with some questions, and this is a topical one. Stuart, are there any implications of further industry consolidation post the bid for EasyJet and how is the industry landscape changing?
I'll start with the second half of that. I think this is an industry where indiscipline has driven down profits or kept profits low for most of its history. And I think one of the things that we're really benefiting from today is that consolidation. I think the US is sort of over 80% consolidated in the top 5 or 6 players. I think Europe's probably about 75% consolidated. It's not necessarily always through M&A. I think scale is increasingly important. Your ability to have a network, have a schedule, offer attractive prices is something that bigger airlines can do better than smaller airlines. I also think access to attractively priced aircraft, being able to do good airport deals, being able to buy fuel at better prices, all contributes to that. So, sort of on an organic basis, more and more capacity is being managed by fewer players, which is a much better situation for all concerned. In terms of sort of the M&A at the moment, I mean, from our perspective, we looked at Air Europa a couple of years ago. We thought that would help to bring us greater scale in Madrid. Excuse me. I mean, Iberia is still smaller in Madrid, significantly smaller in Madrid than most other European flag carriers are in their home hubs. But that got blocked by the EU. We'll see how Spain develops. I think we'd always be interested in more consolidation there. We looked at TAP earlier this year. TAP strategically would have worked. So Brazil is a bit of a white space for us. But we are looking to organically now fly to Brazil with the new A321 extra long range, XLR. So that's going well. The difficulties of doing TAP in terms of being a minority owner of the business, Lisbon's a hard place to operate out of. They're planning to build a new airport. That's going to take another 10 years at least. So TAP for us was not the right opportunity. We thought we could deploy shareholder funds in a better way. EasyJet has been talked about for probably 15, 20 years now as an M&A opportunity. I think the buyer has been quite opportunistic. We'll just see what happens there. We're not involved. I think coming back to my overall view, though, if that does get sort of taken over, depends. I mean, there are a couple of options. It just gets taken over, taken out, and maybe returned to the market in a few years' time, or someone sort of starts splitting it up. I think the bits that we would like are the bits that regulators would probably not want us to have. But as I say, we'll see what happens.
Thank you for that. A couple more questions here. I think you touched on this, but again, probably worth just going through. So what's the impact of the Middle East conflict? Looking at the trading update from May, it actually didn't sound that negative. Is that right?
I think sort of timing affected that to a significant degree. So we were probably 80, 90% done with the first quarter by the time things kicked off in early March. We'd have had, again, as I say, probably 80% booked already. We'd have had only a couple of weeks of fuel exposure to the higher fuel price. We had the benefit of Easter. We had some, as I mentioned earlier, I mean, demand continues to remain robust. So Q1 was actually a fairly normal quarter. I think you'll see more of an impact on the second quarter as the price of fuel would have gone up, but would have been quite heavily booked already for the quarter by the time that happened. So we wouldn't have been able to adjust pricing to recover the increase in the fuel cost. So Q2 will be hit, and then you'd expect at the moment Q3 to have been affected to some extent, but we'd have had more of an opportunity to start adjusting fares. And then there's probably a view that fuel, as it comes down in the third and fourth quarter, means that sort of life gets a little bit easier. So Q1 probably not much change. Q2 probably the biggest impacted quarter. I think Q3 will still be a difficult one, and then let's see what we do in Q4. But as I say, I'd expect us to look at sort of tightening up the schedule a little bit and focusing on some slightly higher margin traffic.
In terms of the fuel, Stuart, how much do you hedge, and how far in advance do you hedge your fuel?
So at any point in time, we're probably 2/3 hedged for the next 12 months, and sort of somewhere sort of 1/3 to 40% hedged for the following 12 months. Again, the principle here is to make sure you're broadly aligned with your main competitors, so you're all broadly pricing the same way in the same market. So as I mentioned earlier, the US carriers, none of them hedge, so they're all doing the same thing in the same market in the same way. In Europe, us, Lufthansa and Air France are all broadly 60-odd% hedged on a 12-month basis. It's our policy. We haven't sort of looked at changing that. The worst thing you can ever do is change a policy as a knee-jerk reaction. So look, we will have been buying higher fuel for out of years for a period of time, but that will sort of just smooth the impact of any volatility. And what else? Yeah, we hedge a combination of Brent, jet, and gas oil. We think those are the most economic ways to hedge. It's not quite the same as the low-cost carriers in Europe, who tend to use a lot less fuel. But as I say, as long as you're in line with everybody else, that's where you are. So, as I say, we continue to hedge on a daily basis. We sort of have tram lines. If the fuel price drops, you tend to go up to the upper end of the buying scale, and if the fuel price goes up, you tend to go to the lower end. But we just execute the policy.
Okay, thank you. Next question here is on the loyalty program. What were the main takeaways from the Loyalty Insight Day held at the beginning of June? And is this the most important part of the group now?
So the main takeaways, I think, were the billion euros of profit, the high margin, and the high free cash generation. So one of the things we explained was that as long as you're issuing more Avios than are being redeemed, you're always going to be kind of free cash flow positive, because effectively you're being paid to, let's say, deliver 100 Avios today, and those Avios are not going to be redeemed immediately. They will probably be spread over the next sort of 3, 4, 5 years. So you're always generating positive free cash flow. And as you grow the business, it's fairly likely that you'll be issuing more Avios than are being redeemed. So it's that, as I say, and to the second part of your question, it's now our third biggest business. So after British Airways and Iberia, so BA did sort of just probably 2.5 billion euros of profit last year, Iberia about 1.3, and loyalty sort of 600 million. As you grow that loyalty business, that's where sort of the focus on our margins and returns is important. So 12 to 15%, you can sort of see the resilience of those margins, and you can sort of see the cash that's generated with those margins. And if you look at the three businesses that are least volatile now, it's BA and Iberia, and very definitely loyalty. So as I say, if you're going to take anything away, it's the margin and cash generation of loyalty, and it's the resilience of a business if you look at the three biggest businesses in the longer term.
Thank you. Next question here. How is the share buyback program going? Is it still expected to end on the 30th of September 2026? And is it doing what you would hope it would do?
So the bit that finishes at the end of September is the second tranche. So we split it up into three tranches of 500 million. We did the first one by the middle of May. As I say, we're probably about 200 million euros now into the second tranche, and we will look to sort of execute the third one when we've completed this current one. And that will take us up to the end of February. So again, the principle is that at the end of each year, you've got the money in the bank, you know what your leverage is, you've got a good view of what's going to happen over the summer, and therefore we can announce any buybacks at a point in time. And yes, we think it is working insofar as at the current valuation, it's the best thing we could do with that cash. We think that the balance sheet is very strong. We continue to sort of what I would call tidy the balance sheet up. So again, in May, we tendered for, and I think we've now taken out all of the convertible. That was about capping the amount that we might have had to pay out when it matured in 2028. So we've done that. We've replaced that with $1 billion of sort of what I would call more vanilla debt. So again, a much more predictable, stronger balance sheet with less of the risk involved. We're paying for planes outright. As I said, that just puts more new planes on the balance sheet. So yeah, it's just once we've exhausted all uses of cash, we think a share buyback is the right thing to do, and it's driving good earnings per share appreciation as it's supposed to.
Great, thank you. The XLR is a major new development. Are there any other significant technology step changes on the horizon?
In terms of aircraft, I think the 777s, the new 777s, when they arrive, they'll be 5 years late, but they will be very welcome. So they will be designed to replace some of the older 777s we have. BA's got 42 777s at the moment. So some of the older ones will definitely need replacing by then. They are bigger. They'll all have brand new product on board. They'll have the new first, which is in the process of sort of starting to go onto the A380s. They'll all have club suites. So they will be nice in terms of the onboard product. And like with most new planes, they will be probably about 15% more efficient than the ones they're replacing. So there's a good efficiency, and that's good technology. Other technology, the app, we're sort of slowly starting to roll the app out. The team will bring more developments to that as it starts to get embedded. There's a whole, so BA in the last couple of years have put in a new revenue management system. They put in a new payments platform. They're putting in a new website. They're putting in a new distribution NDC platform, which is what travel agents tend to use. That will give them the ability to sort of sell richer products around the world, bundling and unbundling. Starlink, as you said earlier, will be embedded on the fleet, and again, it's Ryanair coming at it from the other direction. They haven't got anything on board. For us, it's going to be a lot lighter than the existing tech, so it'll actually be a benefit in terms of efficiency. Data and AI. So we're running an engine program at the moment that started in Aer Lingus that helps us monitor and manage replacement parts on the engines. We think if we can use that across the group, that will drive incremental efficiencies. So, depending on how you define technology, we're doing a lot everywhere all the time.
There does seem to be an awful lot going on there. So I look forward to seeing those developments come through. And look, just as a reminder, if you do want to ask a question, please type it into the Q&A box. We've got a little bit more time, so time available if you do have a question. I've just got one outstanding currently, and that is, can you comment on the wing engine problems?
So there are kind of two issues with engines. One is the sort of the design and manufacture of, firstly, the Trent 1000. That there have just been challenges in the design of that, which has meant that it's always underperformed in terms of maybe it's some of its competition. So a GE engine will probably, on the old version of the Trent 1000, spend 4 times longer on the wing before it needs to be maintained. Rolls-Royce have brought an upgrade, so it's twice as good as it used to be, but that's still significantly less good than the GE engine. And then the GTF, which is the Pratt & Whitney short-haul engine, had an issue with some of the materials used in its construction. So that's taken a long time to fix. And then the more general problem is the supply chain. So materials, sourcing materials, raw materials, places where engines can be serviced. So it doesn't take any longer to sort of service an engine. That takes 6 to 8 weeks, but it can take up to a year between when the plane sort of comes out of service and when it goes back into service. So, and you're trying to sort of speed up the supply chain on that side. We're trying to buy spare engines. So we've had some success, but you'll continue to sort of source engines. And within the group, we're also, so for example, as I mentioned earlier, those the Middle Eastern flying, those planes that have come out of service are not being redeployed because they provide resilience elsewhere to the BA network. So as I say, kind of, there is no problem with the engines per se in terms of they're not unsafe. They just take a very long time at the moment to maintain and go through servicing.
Is Terminal 5 at Heathrow full, and are BA moving to other terminals as well?
Terminal 5 is very full. Heathrow Airport is very full. There's probably, I think, sort of there's a little bit of an opportunity for a little bit more traffic into Heathrow with some air traffic control improvements. Longer term, I think there are sort of opportunities in terms of terminal location to unlock a little bit of growth. Terminal 5, as anyone will sort of see sometimes in the morning, getting planes on and off stands will tell you how full it is. We're continuing to invest. So lounges is the key area. Heathrow operates the baggage system, which unfortunately is quite old now. So there have been a few issues with baggage. You'd like to see them resolve that at some point. But in terms of absolute capacity, I think, what is it? There's sort of 60, 70 flights a day go out of Terminal 3. Those are designed mostly with the American Airlines flights and connections in mind. But we don't really have anything beyond that. Again, more broadly speaking, every new big plane that comes in will replace a small plane, and the small planes are all being replaced by slightly bigger versions. So a 319 is being replaced by a 320 or 321, so there's more growth for BA there. And then you'll have a short haul plane being replaced by a long haul plane as the sort of the 350s, the 787s, and the 777s start to get delivered. So BA has a, excuse the pun, runway for growth there across the next 10 years that probably very few other airlines can achieve.
Great. Thank you, Stuart. There are no further questions, so that does bring to an end today's webinar. As I said, as you leave, it'd be really appreciated if you could complete the feedback form. Thank you for attending today, and we hope to see you all soon. Thank you and goodbye.